Good evening, everyone. Welcome to PersonalFN's Web Summit on the fastest growing investment opportunity globally. It has been a few days now. We have been telling you about this exclusive webinar. And finally, here we are. What exactly is this great investment opportunity? You will soon hear it from the senior fund manager who is widely interviewed and quoted by the media. The theme, which my guest today will discuss, has a lot of material impact on our lives, livelihood, and investments. The theme is fundamental to our progress and sustainable living. The value of global assets signing up for this high investment opportunity has tripled over 8 years in 2020 to a whopping 40.5 trillion US dollars, according to the data from the UNPRI. And I'm sure you do not want to miss out on this fastest growing investment opportunity. So keep watching. In this exclusive web summit, viewers, today you will learn why this is the fastest growing investment opportunity globally, how you can ride the opportunity right here in India, and the proof that this opportunity is already beating the market. My guest today is Chirag Mehta. Chirag is a senior fund manager at Quantum Mutual Fund. He manages the Quantum India ESG Fund, Quantum Gold Fund, plus a few other schemes. He has over 15 years of fund management experience. Chirag has to his credit an MMS in finance. He is also a qualified chartered alternative investment analyst, one of the few in India. CityWire chose him as one of their top 40 under 40 fund managers worldwide in 2017. His views are extremely insightful. In this web summit, join Chirag in conversation with Ghazal Jain, his colleague and associate fund manager. Over to Chirag and Ghazal for their insights.
Thank you, Ronak, for having us here. Without keeping our viewers waiting, let's dive deeper into ESG investing. So over to you, Chirag.
Thank you, Ghazal. Thank you, Ronak. Yeah, it's been incredible how fast this place has grown. So if you see managers with over 12.9 trillion just had a big investment call, they are moving their investments into ESG in a big way. And I think that this trend that we are seeing towards ESG investing is only going to grow from here. It just started, though it's not new. All this started in 2006, and I think much before that, called by different names. But this theme, I think, is here to stay. It's only going to grow from here. Let us see what kind of trends we are seeing unfolding on that side. Does it have merit to look at this space? And what is in it for investors? So I think that this could be the fastest growing investment opportunity that we're seeing globally. And this kind of global trends are usually more persisting because it has a buy-in from everyone across the globe, right? So let's see a few trends on that. If you see right from 2006, when UN adopted the principles of responsible investing, it's only kept growing from there. And it's not only growing in AUM, which has grown significantly larger, even the number of adopters have grown significantly. So today there are more than 3,000 institutional investors who have signed up for ESG investing, or what is called as responsible investing or sustainable investing. It all nearly means the same. And look at the asset growth. It was very low, less than $5 trillion when it started. Today, it is more than $100 trillion in total. And over the last 2-3 years, it's kind of gone significantly higher. So I think this trend is only getting started. It's only getting warmed up. I think more and more people will join the list of being a signatory or at least adopting these principles in their own way. And also this AUM that we are seeing grow from less than $5 trillion to more than $100 trillion is only going to increase. So if you see from 2019 to 2020, it's been a big jump again that we have seen at a very high base. So who are these investors who are getting into it? And these are the biggest of investment fund houses that we have seen across the globe. Be it mutual funds, be it fund managers, be it pension funds, be it sovereign wealth funds. Everyone is saying that this our investments has to move incrementally towards ESG investing, right? If you see the likes of BlackRock, the CalSTRS, the California pension funds, which we known as CalSTRS, they are also moving into this. Norges Bank, T. Rowe, Children's Fund, Swedish pensions, all are moving towards ESG and adopting ESG and embracing ESG in a very big way. And if you see the total size of these institutions are significantly large, they total up to $110 trillion. But if you see individually also, they are into billions and trillions dollars each fund house. And given that these are, they are just adopting ESG, this space, which is about 25 to 30 trillion dollar now, is only going to increase in leaps and bounds going forward. So these institutions and more will incrementally move towards ESG investing. The 3,100 signatories that are there today will easily cross, add more thousands investors every year, I guess. So this space is bound to grow from here on. Let us see what makes these fund managers so bullish on ESG. What are they thinking about ESG? So if you see ABP, which is a Netherlands-based investment fund, they are saying that it helps to improve the risk-adjusted financial return. So they are not looking only at the risk, but they are also saying it helps in augmenting the return, right? We have Norges Bank of Norway, the sovereign wealth fund of Norway. What they saying is it promotes a long-term economic performance and reduce the risk. So it helps in, again, reiterating the same point that we saw in the previous slide, that it helps in adding to the long-term performance of their investment. At the same time, reduce the financial risk that are associated with bad economic and social practices. We also have AP2, which is a Swedish pension. They are saying that environmental and ethical issues can enhance a company's value. So if you take care of environmental problems, which are growing significantly, as we have seen with the COVID crisis, or be it before that in terms of the forest fires that we have seen, or be it with floods, we have seen every now and then there have been environmental impacts that have impaired investments. So if those investments are taken care of and in companies geared to mitigate those challenges, it could really enhance companies' value. We also have Robeco, which is kind of growing big on the sustainable investing team. They're saying that it has worked as a performance cushion during the sell-off. It's not just a luxury in a bull market, but a necessity in bear markets. So it kind of reiterates that it helps during good times, but it kind of really helps when it counts. When things are going bad in a bear market, it really helps. ESG investing shines during that point of time. What does, again, Storebrand Asset Management, which is a big asset manager out of Norway, what are they saying is these factors, ESG factors, are not just nice to have, but drivers of outperformance. So it is good to have, but the main thing it does, it adds or delivers outperformance to your investment. So it's just not a kind of what people have a misconception that it's just doing good. No, you're not doing charity. It does help in your performance of the in the portfolio that you have, if you have ESG-led investments. And how this trend would likely unfold. This is based on surveys of various asset managers, the investment funds, how they're committing big to ESG. If you see how it has been growing since 2000s, slowly, steadily, but keeps on growing. And now I think it's the inflection point that we are likely to witness, right? This year itself has been a good inflection point in the previous slide, as you saw. that it has grown significantly this year itself. And I think this trend will only exacerbate given the pledges that people have as in terms of moving towards ESG kind of investing. So if you see, there are kind of trillions of dollars that will come into ESG-led investment, given that these fund houses that have signed up for ESG manage trillions of dollars, right? And more adopters of ESG will join them. And therefore, this space is only bound to grow. And the incremental money that will come into ESG investing is only going to grow from here. So we are close to about $30 trillion at the end of last year, which will grow to about $150 trillion over next 10, 12 years, right? So that's a significant move into ESG. If such money is going to chase that theme, you need to be early in adopting that theme to take advantage of all that money will flow across the globe into ESG investing. This is again a survey from Callan Institute, which says that in 2013, about 22% institutional investors were adopting or incorporating ESG factors. In 2019, this has grown to 42%. And about 51% incrementally say that they will consider ESG with every investment manager or selection that they do. So it's clearly moving into ESG. And quote from the biggest pension fund out there, the GPIF of Japan, says that coronavirus pandemic, because of that, there has been no change to their goal to move towards ESG. So if there are any misconceptions that investors have that COVID could kind of have these guys or these institutions factor more of returns into their investing, it's not that. They are kind of moving more towards ESG. I think COVID has been that inflection point that ESG was looking for, because it has highlighted the importance of having ESG into one's portfolio. And I think it's only about to grow. It's only going to accelerate from here. So if you want to take advantage of all this money flowing into ESG, be early adopters of that change that we are witnessing across the globe. Again, this is professionally managed assets in the US, which has been rising. I mean, from an ESG perspective, it was in 2012 about ESG mandates where if you see 3.7 trillion vis-a-vis the larger chunk, which is non-ESG. Now, if you see, it has grown from the 3.7 to 12 trillion. And if you see going forward, as more and more investors are looking to embrace ESG, it's going to become from 12 trillion to 34.5 trillion. This is given by Deloitte, a survey done by them, incorporating what investors are saying in terms of adopting ESG. And this is how it looks, from 12 trillion to 34.5 trillion. So that pie is going to grow significantly. If you see, it's going to be half and half by 25. Whatever money they are managing at that point in time, half of that will be ESG mandates. So that's going to grow significantly. So why are all these institutions or investors moving big in ESG? Are they trying to change the world? No, I don't think so. They're trying to change the world. They're trying to see what's happening around, the changes that are happening around, and trying to incorporate that in their investing. So one big reason I think they are moving towards this, because there is enough evidence that suggests that ESG works. ESG delivers good returns. And I think that has been a confirmation that ESG delivers returns and also does good to the society that we live in. So, but most importantly, because they also have to generate returns because of the mandates that they have, be it a pension fund, be it a fund manager, at the end of the day, they need to showcase returns. And ESG investing has given enough evidence, which we'll see in slides going forward, that it does deliver good returns. And that has been a paramount acknowledgement of investors moving into this space, because they see that evidence. So if you see the blue line, which is MSCI India ESG Index, vis-a-vis the orange line, which is the MSCI India Index, the normal stock market index, right? Uh, if you see, the ESG index has outperformed the normal stock market index by a significant margin. If both started at 100 in 2007, the normal stock market index is at 118, whereas the ESG index is at 207. That's a significant outperformance, right? And more so, if you see on the table on the right hand side, it does tell you that years when stock markets fell significantly, like 2008, 2011, or be it 2018, ESG funds, ESG index fell lesser than the normal stock market index. So it not only does outperform over the long run, and that outperformance is widened. It's not just one period of outperformance where that kind of dominates, but if you see, that gap has been widening significantly over a period of time. So that really tells you that ESG does outperform, and it protects downsides when it counts. So whenever there is a bear market, they kind of fell lesser. Similar evidence we see in Nifty indices. The blue line is the Nifty 100 ESG index. Out of the Nifty 100 index, you take good ESG companies and you make an index out of it, vis-a-vis the orange line, which is the normal Nifty 100 index, right? So if you see, even here, the Nifty 100 ESG index has outperformed the Nifty 100 TRI index. And if you see in terms of yearly performance, there have been periods of outperformance during a bull market as well as in a bear market, right? In 2012, markets went up by 30% plus. ESG index was very close to 35%, whereas Nifty 100 index was close to 32%. So there was an outperformance, right? Even during a bear market like 2015, or even this year, YTD, if you see, this has been a true test of ESG because there was significant downfall in equity markets. The normal Nifty index fell by 8%, whereas ESG fell just by 3.3%. So there was a significant outperformance this year as well. So it not only in up markets, it also does well in the down markets. Now, this is a long-term comparison of how these normal stock market indexes have done vis-a-vis how the ESG indexes have done. The purple line and the orange line are the ESG indexes, whereas all others are normal stock market indexes like Nifty, MSCI India Index, or BSE 200 Index. So if you see clearly, the ESG indexes outperform the normal stock market indexes, the market cap weighted indexes. So it has given higher returns over the long duration. Plus, if you see, they have been less volatile as compared to the normal stock market indexes, and they are protected downside. So all in all, if I have to summarize this, it's been a sustainable profitability that these indices have delivered over the long run. Again, the same data in tabular format. The ESG indexes, the MSCI one has 11% return. The Nifty has 8% return. Everything other than that is closer to 6% or below that, right? Most important, the drawdown. Drawdown is the biggest fall that these stock market indexes have seen since 2011, right? Nifty index fell by 34%. And if you see BSE 200 by 28%, whereas these both ESG indices, the last row there is minus 22, minus 26, so much lesser than these normal stock market indexes. So it has protected downside and delivered better performance when it over the long run. That's about the indices, right? But is there merit to look at ESG companies? Of course, the ESG index is an amalgamation of companies that you own, but let's look at some examples where companies have practiced good ESG and how their returns have been vis-a-vis other companies in the sector, right? So this is FMCG sector. Everyone knows Marico. Marico manufactures parachute oil, their biggest product, right? What does this company do? Some trades on ESG, right? So this is a family kind of business, but it's managed very, very professionally by a professional CEO on board. despite the promoter holding being as large as 60%, right? Most of the board members that they have are independent, right? And in terms of the environmental things that they kind of practice is 37% of the material is from renewable sources. 93% of the packaging that they use is recyclable. They implemented responsible sourcing guidelines. The raw material of making coconut oil is coconut, right? How their coconut is being procured. Is there response? Is there produced responsibly, or is there kind of child labor involved there? They need to take care of that, right? So all in all, if you see, Marico has given over the long run since 2005 till 2020, or last 15 years, a return of close to 26% compounded year on year. Whereas if you see the larger companies in the sector like Hindustan Unilever, Colgate, have all trailed returns that Marico has produced. So a good company, these are just a few examples of ESG traits that they have. The list is much, much bigger. But again, this tells you that it's a responsible company. It does take care of environmental, social, and governance. All three are up to mark in this company. But if you see, that has driven the outperformance, because these companies are kind of forward looking. They kind of make themselves ready for step 2, step 3, much more when other companies are struggling with the step 1. So they are really forward looking, and that showcases in their performance. Similarly, one more company, if you all know, cement is a highly polluting industry. Close to 8-10% of global pollution comes from the cement sector. Yet many companies in India in cement sector are doing much more than they should, not only producing cement, but ensuring that they pollute as less as possible. They are trying to be the leaders in the industry across the globe, and ensuring that they have better environmental practices, right? So Sri Cement is one example which has excellent uh, uh, environmental measures in place. So if you see what kind of things that they do, is 39% of energy. Energy is a big component, like electricity is a big component when you manufacture cement, right? 39% of the energy is produced from renewable sources. They use waste heat recovery systems. They use solar energy to get their energy. 23.5% use of alternative raw materials, like limestone is a key ingredient in manufacturing cement. So have they adopted a move towards going away from limestone? Um, all plants comply with zero liquid discharge norms. They use air-cooled condensers to conserve water. Most of them use water to cool their plants, but they're not Sri Cement. All their contracts with suppliers, they'll go down the supply chain and ensure that all the environmental and social aspects are also a clause with their agreements with suppliers. So not looking only at themselves, they are going down on the supply chain and ensuring that those things are taken care of even in the supply chain. Look at the performance of Sri Cement. Sri Cement is the white line there. It has, since last 15 years, it has grown compounded 30% CAGR, right? Other big companies in the sector like ACC, Ultratech, Ambuja Cements, all trail the performance of Sri Cement, right? These are good traits that a company should have. They will be ahead of the curve when regulations start to unfold. They would already have things in place. They will not have to worry about it and only focus on their business. That is what Sri Cement has done, and that reflects in their performance. Street will reward good practices and give them a higher valuation, or at least a valuation that the leaders command, and therefore that will reflect in the long-term performance of that stock. One more example on the company side, we saw Marico, we saw Sri Cement. Similarly, Berger Paints, paint industry. There are big names out there, Asian Paints, Nerolac. What Berger does, they do good work on the social side. What they did, they provided training to 20,000 unskilled and semi-skilled workers. Uh, they faced a challenge, and they kind of turned their challenge to their advantage, and also helped socially, and added value on that front. What happened was, in rural areas, it was difficult for anyone to paint a house, because they were worried, because women were alone at home and they were uncomfortable when they were out at work. Other men come and paint their homes, so they were really uncomfortable there. So what Berger Paints did, they imparted training to women, have women go to these houses in rural areas and undertake the painting job. So people didn't kind of have issues with that practice, and what that did is they increased their business. They increased income for these women because they got them jobs, and high-paying jobs. Usually, women would get around 4,000-5,000 rupees a month uh, to do work. Because of this high-quality work, they could get 14 to 18,000 rupees. So that helped socially as well. And from a governance perspective, this company is managed by a professional CEO, despite the promoter holding be as high as 75%. So still a good governance practice. And they use environmentally friendly products. So they are good at social cause, they are good at governance, they are good at environment. So Street will reward this kind of companies. And look at the performance of Berger Paints. Since 2008 till 2020, or last 12 years, the company has grown 35% compounded year on year. People talk about Asian Paints, how it has been a multi-bagger. But if you look at the performance of Asian Paints, it's 26% compounded over last 12 years, whereas Berger is 35% compounded. So good ESG practices translates to good performance. And that is what we have usually seen in many companies. Why does this happen? Why do good ESG companies kind of perform better? Is there a logical conclusion to that? Yes, there is. There is a study by Oxford which studied 200 academic studies in this field, and what they found was good ESG companies, right? Good sustainable companies have lower cost of capital. 90% of them have lower cost of capital. 88% of these companies have higher operational performance, and 80% of these companies have better share price performance, right? Why does this happen? To give you a few examples, a logical flow of that is strong ESG companies will be more competitive because they're ahead of their competitors, ahead of looking at regulations, ahead of looking at trends, and therefore they are geared up better than their competitors. They have high survivability because they're looking at a holistic view of what their operations have impact on, and they are taking care of that. So given that they are more competitive, there will be a higher profitability and therefore higher dividends. They have better risk management practices. They have lower tail risk. So whenever markets fall, these kind of companies stand out because these are quality businesses at the end of the day. And these have given that they have lower risk, they have lower cost of capital, which translates into higher valuation, right? So it all looks logical that good companies at the end we know are rewarded by the street, and these traits are something that help these companies perform better than their competitors or than other companies in the sector. So if you see from a ESG, we saw indices, we saw companies. Now let's look at real world example of our fund, how our fund has done in a real world. We have completed more than a year time frame now. We launched in July last year. So how has our fund done vis-a-vis other indices, right? We saw in last 1 year has been a really an year of events. We have gone through various phases of market. First, it was an up move, then we saw a significant down move, and then again a rebound. How has our fund done in that time frame, right? So our fund has given a 3.5% return vis-a-vis an ESG indices, the Nifty ESG index, which is around 2.7. So we outperform them. whereas BSE Sensex 30 TRI, Total Return Index, is minus 1.5. So broad market is negative, whereas if you see our performance over last 1 year has been significantly better than that. Over last 1 year, or since the inception of the fund, we have given close to 5.6% return. ESG index TRI has 6.6% return, and BSE 30 TRI has 1.47% return. So we outperformed the broad index, slightly underperformed the ESG index. So in your real world, the ESG indexes or ESG fund has outperformed the broad market indices like Sensex TRI. So what is ESG? Let's look at something. We saw some examples of companies, but what does really ESG entail? What are the things that ESG looks at? So time and again, you would have seen different words being used interchangeably. They are somewhere similar, but there is difference between each of them. You would see sustainability, responsible investing, impact investing, clean investing. So all this encompasses, and ESG is a holistic approach to that includes all of these and more closer to sustainability investing. We all talk about shareholder value. We should get profits over the long run. We should have better returns on our investments. So what we are trying to see is from the companies that we invest, there to be an enhanced shareholder value. When this shareholder value will enhance, when the corporate lives longer, the more cycles they grow through, more profitability will be seen. If it is not a good profit-making company, it will die. It will not be able to survive for a long term. And when you can enhance shareholder value, or when you can have that corporate longevity, is when you only have a positive societal impact. If you are harming the society, if you are polluting, if you are endangering the lives around you by some means or the other, the company or street will not reward that kind of companies. And therefore, any company can enhance long-term value only by having a positive societal impact. So let's see, what is ESG investing? It's about replacing the question, how much return to how much sustainable return, right? Returns may be higher or lower in the short term, but only sustainable returns will be better in the long run, right? So in terms of, there are 3 P's: planet, people, and profit. Is the company taking care of all 3 or not? Only companies that take care of all 3 will likely do much better, like the examples that we saw in the past. They will be able to do better only when they take care of the 3 P's, planet, people, and profit. So in the planet, how company is gearing in terms of environment? Is it causing a lot more pollution? Is it kind of emitting large amount of greenhouse gas emissions? How is the water usage? What is kind of waste management practice the company has? Is it just dumping all the waste in rivers and lakes? So do you want to invest in such kind of companies, is the question that you should ask yourself, right? In terms of social, we all know about social is a lot bigger than CSR, but we all talk about CSR of companies, right? So there are companies, or there is a mandate by the government that 2% of the profit should go as CSR. But is company genuinely doing CSR? Because this, at the end of the day, is profits that you are compromising of your investments that should go towards CSR. But is the company really doing CSR? We have seen many companies that just do it for namesake. They kind of, CSR also includes donations to educational institutes. But if you're doing donations to educational institutes where people of the rich go, are you really doing CSR, right? That's a question you need to ask companies. Is the company clean on its CSR practices or not? We also have labor practices. What kind of labor practices do we have? Privacy and data security has become very, very important. How is the company complying with that? Does it have those practices? If it is not geared up to protect customer data, then there will be regulations that will come, and those companies will have to face penalties, brunt from the regulators. So all this is very, very important. From a governance perspective, governance has always been important across the globe and more in the Indian context. We have seen there is a requirement for board independence, but if the board members are handpicked by the promoters, who are his friends, families, uh, relatives, then is that board really independent? That's the question. There are always questions on executive compensation. The CEO salary or the promoter salary is multiple times than what it should have been as compared to the average wages. Is that company going to prosper? We have seen minority shareholder not treated fairly. Promoters get X and minority gets X minus Y. Is that fair? We have seen many companies where business ethics are questionable. There is fraud, there is corruption. So do you want to be part of such companies? Because these are really high risk that the company faces, and if these are not taken into consideration when you invest, there could be issues down the line. So don't focus on only returns. Risk is also an important part. When you don't have that risk, that will automatically translate to better returns over the long run. And if you see, all these factors are very, very material. These are non-financial factors, but have a very material impact on the firm's valuation, right? You cannot ignore these factors. They are really important factors for you consider in one's investing. So let's look at ESG, how it kind of is important. Uh, if you see from an environmental perspective, when you're investing in Indian companies, which kind of broadly uh, identify how India faces, or India is poised on the environmental front, like water stress. 54% of India is under high water stress, right? 21 Indian cities will run out of groundwater this year. That's the estimate. Uh, we have very high reliance on fossil fuels. We use coal has been a biggest energy component in our basket of energy that we derive from. So so that is going to be a challenge. How do we move from fossil fuels like coal to clean energy? We are already number 3 globally in carbon emissions, though we are low on a per capita basis. But you need to keep in mind that we are a growing economy, and with growth, we have seen increase in carbon emissions. So we are already number 3. If we kind of incrementally add more to our carbon footprint, is the world going to tolerate that? 11 out of top 12 polluted cities are in India. So we have whole host of problems on the environment front. Water, fossil fuels, we're already high carbon emitters. We have very high polluted cities. So this will sooner or later come to haunt companies who are not geared up to face this challenge. On the social side, we do have a very big problem, very pertinent problem, and it's been there for a very long time, right? We have about 18% of the population under poverty line. We have a kind of mismatch on food security, though we are okay right now. But if you see mathematically, we have 2.4% of world's land and 17% of world's population to feed. That's a big mismatch that we have. This calls for incremental increase in yields on food production, but we are not focused so much on that front. On the employment side, we have lowest participation rates of working age women. About 25% of women are kind of unemployed if you look at the data. Uh, Still, we have a literacy problem. More than about 50% of people are still illiterate. Basic hygiene, we are just moving towards some basic hygiene. If you see Mr. Modi's Prime Minister's toilet program, it just kind of moving towards providing basic hygiene to people in rural areas. Uh, so there are problems on healthcare. Also, we have a big problem. COVID has again reiterated that we have a big problem on the healthcare front. 50% of villagers have no access to healthcare services. So that is a big problem that we face even in urban areas. If you see, there was a big mismatch in terms of the number of people requiring medical assistance and kind of number of hospital beds that we had. So we are really poor on that side. So it's kind of, we are focused on economic growth, wealth, profits, but you need to understand that society and all these material things of economic growth, wealth, profits are all sailing in the same boat. If you ignore that, the boat may drown. So social aspects are equally important, as does environment and as does governance. On the governance front, we do have a big problem. We have seen time and again, there have been issues with companies with bad governance practices, and how that translates into poor returns that investors have to face. So if you see, credit rating agencies have been behind the curve. Repeatedly, there have been issues. We had defaults in ILNFS, Z Group, DHFL, and credit rating agencies kind of downgraded those after that event happened. Before that, they were all good companies, highly rated. But when that event happened, credit rating agencies were not able to foresee that issues, and therefore had a big problem on that front. We already talked about dependent independent directors. If independent directors are handpicked by the promoters, so are they really independent? In India, we have a typical problem. About 15 of the 20 business groups that we have, a large chunk, are family owned. And when they are family owned, they kind of shape up the company or rule the company like they want, right? So they are prone to governance issues, issues with mistreating minority shareholders. Those issues will keep prevailing or likely prevail in these companies. Also, we had an audit crisis in 2018. We suddenly had auditors of more than 200 companies resign, whereas if you see the same number a year back, it was just 18. So overall, why this suddenly is big? Because the onus was shifting. Auditors were being held accountable rather than just being a sign off on the audit report. They were being held accountable for any wrongdoings that were in the company. So when that onus shifted, many of these auditors said, we better resign from these companies. So this was ESG, all very important for India, all very important for your investments. And if you don't take that into account, what are kind of risks that you face? So if you see on the global map, India is greater than 5. So it is very, very important. So it is between 4 and 5 rather. So it is very, very important, which says that on the ESG footprint, India is a high risk country, right? So India has high ESG risk. Foreign capital coming into India will see this and say, India is a high risk, high ESG risk country. I better take into consideration the ESG risks my capital will face. So this capital is likely to be moving towards better managed, well-governed, ESG compliant companies. This is again a similar assessment by GMO, which says that if you see India compared to the emerging market counterparts, India is a high ESG risk country. In all 3 parameters, there's more than neutral risk. So investors looking at this data will say that I will ensure that I am not taking this ESG risk. When they come to India, they're already taking a risk, though there is growth, but there is equally and high risk associated with it. And they don't want to add the ESG risk along with it. Given that they are gearing towards more ESG investment, more and more capital is any which way is likely to flow into ESG-led investments. And there is more to it. Not only these investors looking at India as a high ESG risk country, but if you have not incorporated ESG risk in your investment, there is likely to be bigger losses in those companies. For example, J&K Bank, there were investigations against the former chairman on loans offered to people recommended by politicians, diverting funds from the bank's CSR initiative. So these were typically governance and social problems, right? When these were unearthed, the stock fell by 20% in one day. Sun Pharma, we all know there were whistleblower allegations on the financial irregularities in the company, a big governance question mark, and therefore the stock fell by about 26% in 2 months. Manperson Beverages, a well-known case. Uh, Deloitte resigned as the statutory auditor, saying in a letter to the board that the company does not provide it with significant information for to make various disclosures, right? Again, a governance problem. Stock fell by 40% in 2 days. Vedanta, again, a good example on environmental front. Government rejected Vedanta's bauxite mining plans because it was kind of adding to pollution in that region. The stock fell by about 66% in 2 years, right? After that news was broken out. So we all know these various governance, environmental, social issues. The biggest issue that we saw in Jan 2009 was the Satyam. Satyam was a big part of the index. And the chairman, Mr. Raju, confessed of accounting fraud to the tune of 7,000 crores, and stock fell by 78% in one day. So these losses of non-adhering to governance, social, environmental issues are very real that you get as an investor. So everything looks good until this kind of thing happens. And when it happens, the stock market reacts and reacts very strongly. So we have seen various big losses that companies with bad ESG face. So you need not only from good returns perspective, but also mitigating these risk perspective, you need to incorporate ESG into your investing. So what is our idea at Quantum of delivering this ESG long-term value to you? So when we analyze companies in ESG, we are guided by materiality of issues. How material this would be, what is the impact of what the company is doing on ESG practices of the company. So if it is non-material, we may live with it. But if it is material, it has a bigger impact, then we will not permit. So materiality concept is very, very important. For example, for a IT company, environment may not be such a big problem, but for a manufacturing unit, environment, because of the pollution that the factories emit, is going to be a big problem. So you need to see how material the E, S, or G is to that company, and therefore analyze that. Governance is very, very important to us. If you don't have good governance, environment and social will surely not be looked at, right? So if you have good governance, if you have a good board, if you have a good management, then they will worry about the environment, they will worry about the society, the actions of their business activities on these two. So governance is very, very important when we analyze things. We focus on areas such as capital allocation, decisions by the company, board compositions, quality of disclosures, how the minority shareholders are treated. We all, as investors, are minority shareholders, and how the company treats us is very, very important, whether to be investor in that company or not. Shortcomings on environment and social will also go in hand with wider problems in the company, and therefore poor performance of the company. What we are essentially trying to do is trying to identify long-term stewards of capital so that we invest in a company, a good company, and it delivers over the long run. Something that not only takes care of adding value to shareholders, but also looks at the environment, society, and has great governance. So how do we evaluate a company on ESG? We look at various data sources. Companies publish something called as sustainability reports. SEBI has mandated top 1,000 companies to release something called as business responsibility report, or BRR. There is a sustainability account board that gives us various guidance in terms of the materiality of factors to a company. there are pollution board filings by the company, there are industry association reports, there are news reports. We also look at NGO reports, because NGO kind of highlight a problem with the company. So we look at those reports. We look at management interactions. We go and meet the managements. We do a 360-degree check on the company. We try to meet the vendors, the suppliers, the customers, the employees, try to get feedback from everyone, and try to analyze the company on a holistic basis. So disclosures get a 30% weight, and we analyze each of the disclosure qualitatively, which is a 70% weight. We arrive at a score of the company. The score of a company typically ranges from plus 30 to minus 70. So we have a comprehensive mechanism, and this has not evolved in last 1 year or so. We have been working on evaluating the companies on ESG, gone through a learning curve, and have evolved a process. We started working on this independently in 2015. We have an in-house proprietary process to analyze companies on ESG. So it's been gone through a learning curve and have established a robust process around it. So how we build a portfolio is we look at an addressable universe of any company that trades more than $1 million per day. Company is very, very liquid. We will buy those companies. So those companies in today's trading volumes amount to about 450 plus stocks. Then we analyze these companies of wherever there is enough information available to analyze these companies on ESG. We analyze those companies through using a proprietary ESG process. Those companies where we have enough information to evaluate them today is about 125 stocks. We have evaluated all these 125 stocks. As I said, disclosures are getting better from the companies, so this will also grow significantly. And when we score company, and depending on the score and the sector weights of those companies or the sector guardrails that we have in place, we try to build a portfolio of 40 to 60 stocks. So investors will get a broad basket of ESG compliant companies, which will kind of outperform over the long run. Remember, we are trying to select long-term stewards of capital that can handle your capital well, that can grow well, that can ensure that there is a ESG compliance in place. So overall, we try to build a robust portfolio of 40 to 60 stocks for you. So again, the portfolio construction process, we try to look at the volume of the company, whether the company is under active coverage. We only buy companies where we have evaluated thoroughly those companies on ESG. If it's not, it just goes back to research. We try to buy at least 0.5% of the company. When I say 0.5%, we'll round it off to minimum 1% weight in the portfolio. But the ESG score should be such of that company that it should get a minimum 0.5% weight in the portfolio. So overall, you will see companies with a weight range of minimum 1% and maximum 5% at cost. At market value, we'll allow that company to run up to 10% of market value. Anything beyond that, we will sell, we'll book profits, we'll trim those weights. So there are, we try to build a well-diversified basket of ESG compliant stocks. It should be diversified across sectors and also ensure that they are good at ESG. And these are how we will go about building your portfolio. So when you look at overall portfolio, what will you end up owning? What are the traits of the stocks that we own through the ESG fund? It's going to be value agnostic. We don't look at valuations. If you're looking at why value agnostic, why not look at valuations? We're looking at strong ESG companies that will deliver, or there's a sustainability will be a driver of long-term performance. And so we don't want to look at valuations, but look at how good are they at ESG. If you see most of the stock indexes that are there, like BSE 30, Nifty, or any of the ESG indexes, are value agnostic at the end of the day. They don't look at valuation. They look at market cap of those companies and then they allocate. Here we look at ESG of those companies and then allocate. So ESG, if you bifurcate the factor exposure that you end up having, is exposure to quality and low volatility factors. This has been proven by research that ESG provides you exposure to quality and low volatility factors. So whenever you see a sharp fall in markets, quality and low volatility is something that shines, and therefore that makes ESG also shine during that time. So they tend to do well in down markets. They avoid tail risk, though the Satyam like risk that we spoke about. ESG will stay away from those kind of risks. So whenever that materializes, you don't end up losing a big chunk of your capital. And at the end of the day, we'll try to deliver long-term risk-adjusted performance for you. So if you see the current portfolio that we have for the ESG fund, it's something looks like this. The top 10 weights on the left-hand side and sector weights on the right-hand side. The top 10 holdings, if you see the top 5, TCS is #1 holding, followed by HDFC, Infosys, HDFC Bank, and Wipro. Top 10, if you see, adds up to about close to 38%. So not a very concentrated portfolio, very well diversified weights, and also across sectors, it's very well diversified. So you have representation in most of the sectors, which gives you enough diversification, but at the same time, more importantly, this has all ESG compliant companies in it. So if you see materials, technology, consumer discretionary are top 3 sectors. Financial usually make up a very high weight in normal indices. We have a low weight there. We will only add weight when we get good ESG compliant companies in that sector so that we don't take overt risk. But overall, if you see, it's very well diversified across market cap and across sectors. Many people or many investors might have a question that governance has been a forte for the quantum long-term equity fund. It's been an important pillar in how they also look at stocks. Governance plus valuation key criteria is there. In ESG fund, it is governance, and then not only governance, but a holistic view on ESG, environment, social, and governance is the focus of the fund. If you see, they are not very similar portfolios. They are very, very different portfolios. Only 14 stocks in common. And these 14 stocks just make about 41% in the Quantum India ESG fund and 56% in the long-term equity fund. But if you see, the stock names are 14, but weights could be very, very different overall. So it is not the same. It is very, very different portfolios, very different focus. The commonality between both the funds is strong emphasis on governance. So overall, what are we trying to do is when you as an investor, you have a belief system, a value system, it's time now to vote with your wallet for the beliefs and for the values that you stand for. So if you think your value system aligns with clean and environmental friendly businesses, investing in those companies, businesses that contribute to our society, businesses that have a fair and transparent practices, businesses that are responsible and where sustainability is the driver of long-term returns, then make Quantum India ESG fund a core part of your portfolio. So overall, how does ESG fund fit in your portfolio overall is, if you have 100 rupees in equities, I think you should have about 60 rupees in a well diversified bouquet of equity funds, which is Quantum Equity Fund of Funds. So I have about 60 rupees in there, 20 rupees to Quantum India ESG Equity Fund and 20 in the Quantum Long-Term Equity Value Fund. So if you have exposure to these 3, your equity allocation is complete. You don't have to look at any other fund. These 3 take care of entire equity investments for you. So overall, I will leave you with a message which says that making money, making a difference, you can do both together. You shouldn't have to pick between the 2. It's a myth that you can either make a difference or either make money. You can do both now with ESG investing. Thank you so much for being patient listeners. I hope I have added some value to you. With that, over to you, Ghazal.
Thank you, Chirag. You definitely have. The presentation was very comprehensive, and your insights on ESG were really helpful. So we have a few questions for you now. So can we get started with those?
Yeah, sure.
So firstly, Chirag, why the sudden interest in ESG funds? Do you think there is an investment rationale, or is it just a passing fad?
So I think it has very strong investment rationale, and this is not something new. This has been evolving, I think, since 1997. And if you see, it has really picked up with UN adopting principles of responsible investing in 2006. So over time, investors have seen the merit of having or investing in strong ESG companies. Like we saw those indices, right? Those indices have delivered significantly high outperformance for investors to not look at ESG, right? If you don't look at ESG, you miss out on returns, you have higher risk. And so evaluating overall in a holistic manner, you get better returns with lower risk in ESG. So there is compelling evidence out there. And that is why incrementally you have seen that people think that investors think that this is something that you cannot afford to not look at, right? You have to incorporate ESG factors. And somewhere at the end of the day, there is also a fiduciary duty when you invest. You don't want to invest in companies that are highly polluting. So at some places, it has been driven by a mandate, but more broadly, if you see, it is driven by high outperformance of ESG investing or associated with ESG investing. So I think it is not a passing fad. It is here to stay because the compelling evidence just kind of adds every year that ESG investing does make a difference in terms of the outperformance that it could produce. And investors gearing up for it.
Very well. So can you tell us about Quantum's evolution and journey into the world of ESG investing?
Yeah, absolutely. So for Quantum as a group, this is not something new. We have been practicing a strong governance since 1996 into our investments. When we manage money for institutions as a group, we have incorporated governance factors, which we called as integrity screen. So if just to explain you our integrity screen, we have a phrase which someone told Ajit when he met that person for the first time, that when you shake hands with someone, if you don't get your 5 fingers back, you don't shake hands with that person ever again, right? So that has been a strong belief. We are strong believers in that philosophy. Unless we think changing 360 degrees, we will not make that mistake again. So if we have found any bad governance practices from any company or any group of companies, we will kind of shy away from investing in those groups. That governance has been a strong pillar of our investment since 1996. In 2015, we the ENS criteria also started becoming more important overall globally, because those risks were increasing, and we couldn't ignore those risks when we look at investing. So overall, in 2015, we said we need to look at these factors holistically, not only look at governance, but also look at ENS of the companies. And thereafter, where we started a team to look at ESG way, and we evolved our learning curve, evolved our process, and now we have a robust process of investing or looking at companies from an ESG perspective. And that is when we launched the Quantum India ESG Fund. So overall, just to keep it short, it all started in 1996 when we look at investing, and that has been our evolution and became more holistic in 2015, of which we became very confident in terms of offering to investors, and then we launched the fund like we always do at Quantum.
Sure. So, Chirag, what would you say differentiates Quantum's ESG fund from its peers?
Yeah, so as I said, we started in 2015 to see how we can incorporate ESG holistically in our approach. So we have kind of gone through a learning curve and now evolved a process which is a proprietary process. Many other funds look at scores from a third party provider, and try to evaluate that into their investing. But we have our own research. We have learned it through various means and ways, and we kind of go beyond desk research. We just don't look at companies trying to score them sitting in at a desk. We go out, do a number of checks. We look at NGOs, meet NGOs. We look at a 360-degree feedback from all the stakeholders. We try to meet customers, suppliers, vendors, and try to evaluate that company holistically. So it's not just desk research; it's proprietary research that we have, and that goes beyond looking at just numbers of that company, and try to evaluate qualitatively that how that company stands on ESG. So it's just not a tick the box kind of approach that we have. We have a very thorough and rigorous process of evaluating companies at ESG. And I think that is a big differentiator on what we bring to the table as compared to many others.
All right. So, Chirag, could you highlight some India-specific ESG risks which would make ESG investing even more relevant for Indian investors?
Absolutely. The like I said, governance has always been a big problem for India, but incrementally ENS has also been. For example, on the environmental side, I think there are very big challenges for India. India is a growing country, and a byproduct of growth is usually pollution, usually high emissions. So I don't think the world is here to tolerate high emissions from India. They understand India has to grow, but that is not something that will be tolerated by the world, because the way India grows, it will incrementally add to world's pollution, right? If India grows by like what China did, like what world did, I mean, looking at the world averages, or maybe like US did, India will add somewhere between 12 to 35% incrementally to world's pollution, given that others' pollution or emissions remain the same. So India alone has a high potential to add to world's emission, which will not be tolerated. If that has not been tolerated, India will be under pressure to commit to various environmental goals. As India commits, there'll be pressure on companies to ensure that India complies to whatever pledges it makes, right? So if companies are not geared up to kind of grow without being big polluters, that's going to be a problem for that company. They could face penalties, they could face brunt from the regulators or the government, and therefore a good ESG company will always foresee these problems and try to ensure that they are well ahead of what the regulatory requirements will be. So India has big problems on environmental, social, and companies will have to gear up themselves. So if they are not, there will be big risk to those companies.
Sure. And lastly, Chirag, what are the chances that ESG investing would mean that investors will have to compromise on returns?
That absolutely is a myth. Like the statement here says, you shouldn't have to pick between the two, right? There is a big misconception that if you try to do good, you will have to compromise on the other hand. That could be true in very short-term time frames that you're looking at, but over the long run, it always gonna be a winner. These are strong businesses. They are not only looking at their traditional remit, they are going beyond that, right? They are trying to ensure that their business is taken care of, but at the same time, they are not having a bad impact on environmental, on society, and at the end of the day, they are very well-governed businesses. So I think these companies will always stand out. They'll always get that respect from the street, that in terms of higher valuations that the street is ready to pay, because these are at the end of the day a low risk on a relative basis, and therefore they command a higher valuation, lower cost of capital, those kind of traits that we saw earlier. So I think these companies make for great investing. I think what earlier people termed as blue chips, these are real blue chip companies. I mean, real good quality businesses that you kind of own for your lifetime, because they will always be ahead of the curve and try to ensure that they enhance shareholder value over the long run.
Sure, that makes a lot of sense, Chirag. So with that, we come to the end of the Q&A, and I'd like to thank you again for your time and insights.
Thank you, Ghazal.
Over to you, Ronak.
Thank you, Chirag and Ghazal, for sharing those extremely valuable insights. I'm sure viewers will immensely benefit. Viewers, in case if you have any queries on ESG investing, also known as socially responsible investing, want to know more, reach out to Quantum Mutual Fund. You can reach out on customer care at quantumamc.com or call on 1-800-209-3863 or 1-800-223863 or SMS quantum to 92432 23863. And you can also buy quantum funds on registered online investment platforms. Viewers, hope you enjoyed this web summit and thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.